Hey everybody, Marty Mazzori here. It's July 13th, 2023, Thursday after hours with your end of week stock market snapshot. Clients will send it to you once again as a link in your morning email. This will be Friday's morning message, and then we'll get busy on the weekly economic update that'll come to you either later Friday or over the weekend. Today I'm going to do exactly what I did on the midweek snapshot. We'll look at the S&P, the NASDAQ 100 ETF, Apple, Microsoft, Nvidia, Amazon. Then I want to look at some history of our PWA index compared to the market, and then I'll finish up with a look at the dollar chart. Won't take long on the stock charts because really nothing's changed at midweek. I mean, we've had a really nice two-day rally on soft inflation news, but technically speaking, pretty much looking at the same setups. Did clean up the charts a little bit, make them a little easier for you to look at as I navigate through here a little bit. One in front of you is a daily chart of the S&P 500, and I mentioned on Tuesday evening, sent it out to clients Wednesday morning, that sure, on soft inflation data, which I expected and which we got, and I said the market would likely pop. I said if it quickly turns over or if it doesn't pop at all, you can check the box that says the next leg of the bear market is perhaps beginning, although I said I'm not looking for that this week. So sure, that's one of the things you're going to want to look at is the market trading lower on what would be otherwise good news relative to how it's been trading of late. And what I mean by that is soft economic news, soft inflation news for a market that seems to move up on anything that would suggest that the Fed may stop hiking rates or may start cutting rates. Anything weak, of course, is a good thing. Now, anything weak comports with our overall longer term, say intermediate to longer term thesis, that the economy is at real risk of recession. And if we have a recession and we have corporate earnings in a recessionary environment, we're not looking at a market that's discounting that currently, and therefore we think the market can go a lot lower in that scenario. So folks, while that recession risk is there, or anybody out there who believes it's there, needs to have something going on in their portfolio to diversify away some of that risk, hedge it, what have you. So again, we got the soft inflation print. It was doubled down on this morning with the producer price index, which came in softer than expected. So we had this nice two-day rally. But folks, we still have, these rising wedge pattern here on the S&P against still negative divergence on our momentum indicators. What I did here is I ran it back to July of 2021. Remember, the all-time high in the market happened right at the beginning of the year in 2022. And it's pretty interesting how similar the setup looks today versus then, right? So here you had the market moving up into all-time high territory, right? You had a rising wedge pattern, and you had our momentum indicators beginning to break down right in here, right? And we had it roll over, but we kind of had a bull flag looking pattern, I guess, here. And the market, got bought, that whole buy the dip mentality prevailed. Then it shot higher, right? The divergences were still there, though. The momentum was really rolling over. And then finally the market gave up the ghost and began with a downtrend, lower lows, lower highs, all the way into that October of last year bottom, right? And then if we go back to where the MACD had the last time peaked, right, we certainly have a high from there. And from here, we didn't quite get to a new high on the MACD. So from that perspective, that would be a bearish divergence. It would certainly be one from here. And that's one of those long extended ones that are kind of dangerous setups, if you will. And we got to overbought territory to the degree that we haven't seen since when? Since right back here, back in November of 2021. So then we came back up again, made a new high, just marginally, right? Still had the divergences, rolled over into the bear market. I'm not saying that that's what's going to happen again. I'm just saying we're finding similarities, right? Activity among traders and investors is pushing the market in a way very similar to what it did when we hit the all-time peak. And then the NASDAQ 100 index actually peaked late November 2021. So we had our pattern there. We were rolling over definitely on the MACD, hugely overbought, rolled over on the RSI, and tried to come back here, almost tested the all-time high, not quite, but we were rolling over. It just looked like a, technically speaking, foregone conclusion that the market was, going to get kind of wiped out here. Now, notice, and this was going on in the S&P too, but we won't back up. Notice, we had lower lows here and we had higher lows. So back here, we were painting a short-term bullish picture. And sure enough, we got our rally. Then, it kind of topped out again, and we were just moving our way down the bear market trend line at this point. Tried to pierce through it. Technically, things were looking very iffy. We got to the bottom down here in September, October. Again, here we had a falling wedge. We had our rising divergences, buy signal right there. And we came off of it, came down, tested that level again, but we were still looking bullish, at least on a short-term basis. And then we're off to the races, and we're getting close to that all-time high. Again, more overbought than we've been since back here, but haven't been able to really do much with that, right? So bears who play these particular indicators have been very frustrated, I'm sure, because we've just gotten minor pullbacks here of late, but it looks compellingly bearish to me right here. So we'll see the next few days and weeks if we do get some shakeout here. I'm not sure that we're ready for the next leg of the bear market, which we think is still a non-zero probability, but we think that comes with more confirming evidence that indeed there is a recession on the not too distant horizon, if indeed that's what's going to play out. That will, we think, really do a number on stock prices when that becomes evident. Okay, so Apple, nice defined uptrend line. You can see we're working in a channel right there. Man, here we, you could do that. Bearish divergence, you just bounce back. You're just bouncing along this trend line in here, right? Long extended bearish divergence. Do have a sell signal, but you've had these before to no avail for the bears, right? You're overbought here consistently, and you got to go back to the previous all-time high. Apple's now got a new all-time high, and and a pretty bearish looking setup right there. That did play out ultimately, right? Kind of like the market though. Tested it right in here against bearish divergences, ultimately failed, but then we had a bullish pattern building in here, right? And sure enough, we got our pop. Looks a lot like the QQQ chart that I just showed you. Microsoft, really tough looking chart by our way of looking at things. Hitting that high back there from December of 2021, rejecting it, but trying like crazy to rise above it. The MACD and the RSI are saying that odds favor that it's ultimately going to fail. That would be my base case, but again, a little bit of good news, earnings, what have you. And sure, we could do what we did the last couple of days and push into new all-time highs. It's going to take something on a sustained basis to burn through these divergences, however, right? But again, same kind of thing. Here we are at the all-time high, rolling over. Sure enough, rolled over. Here's these little areas here where we had nice counter trend rallies, got really bullish looking. Boom, nice rally, right? Perfect. Boom, nice rally. And then again, even right in here, all this stuff, pictures that we were painting on the major averages that said, hey, look for a rally right here. On a short-term basis, it was looking bullish. Right now, it's not. Right now, it looks kind of the opposite of these bullish areas. It looks more like it did back when it topped in a meaningful way. NVIDIA, not a chart that I've worked on, as you can see, nearly as much as the others, and more so here recently. But, going back, we did look at it here back in March, April of 2022, and we drew what, looks like a pretty decent bear flag pattern that played out almost perfectly, right, in terms of when it bottomed. And then we formed a good bottom in there. If I were a short-term trader, I would have bought NVIDIA right there. I would have got stung probably right in here. This would have said, if you're swing trading it, you would have got out up there. But right here, this was even more compelling from a technical perspective for sure. And then we just got this massive rally. And of course, that was the earnings news, which, the whole AI story, right? This looks really toppy right now. So we'll see how NVIDIA plays out. I'm showing you these because these are hugely consequential because they are the dominant weights in the S&P and in the NASDAQ 100 index. And then lastly, good old Amazon's got a long ways to go yet to get back to its high and looking problematic here, right? We do have a nice uptrend, losing some momentum here, getting confirmation of that. Coming off of overbought level right there, bearish divergence. It's broken down below the wedge. It's retesting it right now. You get a retest in a bear market. You fail that retest, and then you go back, and you could easily, without really too much trouble in a bear market, get back down here and retest these 80 levels. It'll freak a lot of people out, but that's what happens in bear markets. If indeed this is still a bear market, a lot of people would tell you it's not at this point. So clients and longtime viewers of the blog, this one will look familiar. This is the S&P 500, the white bars. The scores are the scores of what we call our PWA index, which is a indicator of overall general conditions. When it's red or in a negative state, that says that odds favor recession going forward. When it's green, that says odds favor continued expansion. This is something we created back in June of 2017, and then we backtested it back to the late 90s. And it's been a very useful indicator for us. It certainly was in late 2019. So what it had told us on a backtested basis back a few months before the market peaked during the tech bubble, it showed us that recession risk exceeded the odds of continued expansion. But the market from that point still staged another 15% rally before it rolled over. Prior to the great financial crisis, once we turned into the red, again, a 15% rally before we rolled over into the worst recession since the Great Depression. Prior to this very brief recession around COVID, we started flashing red in August of 2019. We had an 18% rally before we rolled over into a 3-week 35% decline. And then this one was unique, right? Because these actually bottomed either a few months before or a few weeks or a couple of months after the actual bottom in the market, right? This one actually kept getting worse, at least initially, as the market began rising. This was unique historically, right? A recessionary bear market, you got to go back to like 1949 to find one where the first bottom held. And it was, I believe it came close to being tested. This one didn't even come close. But folks, we know about this one, right? This is the recession that really never was, or the bear market that really never was, or I should say was not going to be allowed to happen. Gosh, upwards of $10 trillion if you wanted to add all the fiscal spending and the Fed quantitative easing, right? So while the economy looked horrific and it looked like the market should roll back over, it didn't. And by the time we got in here, into later 20 into 2021, we actually turned green again. So our recession signal was off, right? So you may recall, folks, that as the market peaked and began to roll over, we set a target for the S&P of 3,500. We were seeing the bear market develop. We thought there'd be a bear market. We said 3,500 looks like where it should be done. And 3,500 literally is where that little line hit, actually a little below that, on August 16th of 2022. And we bounced off of that. Now, when I made that call, so to speak, I said, however, we're not showing recession risk of concern at this point. If, and we're afraid it may happen, if we get to recessionary conditions by then, sure, market could easily bounce off of that, but we're going to have to call for another leg down once recession actually hits and earnings reflect or respond to that recession. Well, folks, this has been quite the rally. We're still flashing some serious recession risk, and the market has gone up almost 30%. We're not back yet to the all-time high, probably 7 or 8% away, but a 30% rally off the bottom. You would think that you've got all this stimulus going on. You have had a couple of, I think, stick saves in 2023. One was, ironically, the banking crisis. Why did that save the market? Well, because $400 billion got printed up to basically bail that situation out. And that was a real strong signal to the market that, the Fed can talk tough, but if something breaks, they're going to come with the cement to try to fill that crack as quickly as possible. But that doesn't help the inflation scenario, if indeed that's going to happen. If they're going to do whatever it takes to avert something big happening. I don't think they're that afraid of a mild recession. I think they may actually think we need that to get inflation under control. But if something breaks, so we have a credit event, and there could be more in the offing, as there tends to be when we have legitimate recessions, it'll be interesting to see how the Fed reacts to that. The other thing is just, the whole AI craze that really has concentrated this market in a few names that are kind of related to that. We talked about the lack of breadth and so on. It probably just prolongs this bear market rally. Could we go up and test this and actually, in our view, end the bear market and get to new all-time highs? Of course we can. There's some real momentum under this market. In fact, we shouldn't be surprised if indeed that happens. As investors of other people's money, we're going to have to continue, though, to accommodate or acknowledge in our work and in our portfolio allocation the risk of something major to the downside because of what general conditions are telling us right here. Now, some people would say that the stock market is telling us there is no recession. I've heard this in commentary on Bloomberg and so on. And I would say, having done this for 38 years, I've seen it through a few rodeos, right? And well, you can see it right here with these 3 recessions. A rally right into recession is anything but unusual. In fact, I would say it's it's pretty much the norm, right? And again, we only back test back here to 1998, but let's just run this back all the way. Let's go back to 1960. So here we are, right, rallying into the first recession of the early 70s, rallying into the next one, rallying into that one, rallying into that one. Without exception, it's common for the stock market to rally into recession. So anybody who's saying, oh, no, the stock market's telling us there's no recession coming, probably at a minimum needs to go back and do a little chart work. And you may want to cease with that narrative. I want to go back and point out some other things here about our work. So going back to that 1998 on period, this was about a 20% decline. We had lots going on. Asian currency crisis. Russia defaulted on its sovereign debt. The largest hedge fund, long-term capital management, went out of business. And we had, intraday, we had a 20% decline. But when we were looking at general conditions on a back-tested basis, actually they were fine, right? And therefore, that's all we got. We had not quite a bear market. If it would have closed down 20%. And the market came bounding right out of it. For some reason I lost my 2008. The Great Recession happened right in here. But here we had the European debt crisis, right? Things were getting pretty shaky, but overall general conditions were still okay, and the market came back. This was a nauseating 2-year period of sideways action, 16% correction in there, peak to trough. But general conditions were still holding up, and this is where breadth was helping us out a lot. I remember our breadth indicators broke out before the market did, and then we were telling people, looks like this market's ready to go back to its bull trend. Right in here, 2018, I remember doing tons of videos, and I said, folks, we're not getting defensive. This is a steep correction within the context of an ongoing expansion in an ongoing bull market. And that turned out to be the case. Now, here we were at all-time highs, and now we're hedging portfolios with an options collar, right? Which I'm sure people were wondering about, but it's because now our under-the-surface work was saying this risk-reward setup does not allow us to invest like we had all the way from the bottom in '09 up to here. All the way in here was one of the best stretches we've ever had as investors because of our international exposure and so on. So right now, again, from a fundamental standpoint, market's pretty precarious. Technicals are in the eye of the beholder the way we look at the technicals. And those of you who've been with us for years and or watching our videos for years, if we're one thing, we're consistent in the way we look at these things. And these things have done a pretty good job on balance in the long run, giving us what the technical setup portends. Nothing's perfect. In fact, let me give you an example on the dollar. I was saying that stocks have a real headwind ahead of them in July because our work was telling us that the dollar was looking bullish. And again, we were pretty much right on the money. But here, the dollar has just utterly collapsed. Interest rate differentials or the anticipation of such because of this really weak U.S. inflation prints, right? And I think I'll spend some time on that tomorrow or over the weekend on the video. I want to really hone in on how to think about these soft inflation prints. And speaking of inflation, folks, a weaker dollar is very inflationary when you think in terms of U.S. imports, right? A weak dollar is inflation by definition. It's great for U.S. multinational companies, and those are the ones who rallied the most this week, right? The big tech stocks that half their earnings or more in many cases come from foreign customers. So a weak dollar makes our goods cheap, right, in those foreign currency terms, but it makes foreign goods that we buy expensive in U.S. dollar terms. So again, this and some other factors, as I'll point out probably tomorrow, paint a not necessarily friendly picture for what the Fed's going to need to accomplish going forward. Now, having said that, I'm implying that inflation is going to ramp back up the second half of the year. That does fly in the face in what we're saying the risk is to general conditions, and that is that they begin to roll over. Maybe much later in the second half of the year, this seems to be getting pushed back. But that's a real disinflationary environment, as I wrote about in this morning's blog. So folks, look for the general conditions or economic update tomorrow. I think that's going to be a real important one to take in, and I'll do quite a bit of work to give you something that is meaningful and objective and hopefully telling about what we should be thinking about going forward. Thank you, as always, for watching and listening. Talk to you in the next day or so. Bye-bye.